Very good. Thank you, Stephanie and crew. I mentioned I bought a Tesla. So having a self-driving car, yesterday I added Microsoft Word to its AI program. Today the car wrote its own autobiography. Okay. Thought that was a good one too. Okay. Please welcome our next keynote speaker, Claudio Irigoyen, Head of Global Economics Research at Bank of America.
Hi, everyone. So, can we put the presentation? Okay, there we go. Can you guys hear me well? Okay. Can or cannot? No? Can I use this one? Hello? Can you, now? All good? Okay. I'm going to use this one, no worries. I run global economic research at Bank of America, and thank you very much for the invitation to participate. I'm going to speak for about 15 minutes or so, and then open to Q&A, try to give you a flavor of how we are seeing the world at Bank of America. The world is getting really, really complicated. I'm originally from Argentina, and the world is getting so complicated in so many respects that I always make the joke that Bank of America had to appoint an Argentine to run global economic research. And in my previous life, I was a central banker also in Argentina when inflation was single digits a long time ago. And then when we talk about protectionism and tariffs and stagflation and integrity of statistics, I come from the future. So I've seen it, and it's not pretty. So I'm going to start with our global forecasts, then dig a little bit into the US, what are the main topics, the main issues, and I'm not going to have a lot of time to talk about Europe and China, but I'll give the flavor of how I'm thinking about those issues. We expect global growth to be roughly flat at around 3%. All this uncertainty associated with tariffs and tightening of immigration in the US, etc., it's going to cause global growth around 2 to 3/10 of GDP, relative to what we expected before all this uncertainty started to hit the markets and the real economy. For the US, we expect 1.7%. That's definitely below potential, but it's not a recession. We never called for a recession in the US. Now, most of the houses do not have a recession call, but back then it was an out of consensus call. We always thought that despite the massive escalation of tariff uncertainty, there was going to be a quick de-escalation, and we didn't jump into changing the forecast dramatically. And we expect somewhat high inflation relative to US standards for a while. As you can see, we expect Europe to underperform relative to other countries, and China to deliver less than the target growth that they have of 5%. So when we think about tariffs and immigration and all these issues, probably it's better to start with the way I think or we think about Trump policies. And probably now it's more clear because we had a few months and we've seen the administration in action, but back in January, it was really difficult to figure out what was going to happen. And the way we thought about Trump was he wants to negotiate comprehensive country-specific packages involving not only trade, but also defense, immigration, energy, and And when you think about that, that was the lever. This is what we are seeing. Most of the agreements with different countries are not just about trade. It's about many other things. And probably when they renegotiate USMCA, it's going to be clear that there will be some issues on immigration and probably some anti-China type of renegotiation of USMCA. But where we were sort of wrong was under the assumption of where tariffs were going to land after the de-escalation. There was a rapid escalation on Liberation Day. I remember back then, I told my team, we are not going to change the forecast for a week because this is such a big shock to the markets that markets will react to the point that probably the administration will have to rethink about this. And this is exactly what you can see, how the bond market and the stock market reacted back then. And also you can see that the stock market is making new highs every day. The bond market is sort of stable, but the stock market is making new highs every day. So that gives you a flavor of how much liquidity out there is at the global level. I'm going to go back to that when I talk about my view on the dollar. But basically, we expected effective tariff rates to land around 10%, from 2.5% before Trump to 10%. It's a lot, much lower than Liberation Day, but still a lot. Now we are seeing that most of the trade deals validate effective tariffs for the US of around 15%. So that poses upside risk to our inflation forecast for the US and somewhat downside risk for growth. Trump policies are stagflationary for the US, higher inflation, lower growth, and mostly deflationary for the rest of the world. However, the way the deals were negotiated, this idea of I'm going to impose very high tariffs, but you have 90 days to negotiate with me, and maybe I can give you another 30 days or 60 days if trade negotiations progress, creates significant incentives for companies to front-run imports. And when companies front-run imports, they build inventories that they are going to use to avoid increasing prices dramatically in order to avoid losing market share. That means that to the already persistent inflation dynamics that we had prior to this type of shocks, we are going to have more persistency because companies will gradually increase prices in order not to lose market share. But eventually, prices will continue moving higher. And today, PPI numbers confirm that we are starting to see that taking place. So for the US, the forecast that we have for inflation implies a peak of core PCE, the most important measure of inflation for the Fed, for deciding whether to cut interest rates or not, peaking at 3.2% at least in November. But the more you delay the negotiations and the longer the truce, the further away into the future you're going to see those peaks. The issue also is that this is not the only thing that's going on. There is an immigration tightening shock that is impacting the labor market. Probably the peak of uncertainty, we've seen it during May and June. And if you go back to what happened a couple of weeks ago with the payroll reports, you saw that the revisions were mostly, the revision of payroll, downward revision was mostly for May and June. Because in May and June, companies decided a few things. They said, probably, I'm not going to hire as many people as I thought, but I'm not going to fire as many people as I thought because I don't understand the rules of the game yet. And I'm not going to increase prices because I don't want to lose market share. So that means that the effects on activity and inflation of this type of shocks is asymmetric on time. Over time, you're going to have first the impact on activity and then the impact on inflation. In June and July, we are already seeing we have very good data. Our credit card data we have decent market share, and it's a very reliable data. We are seeing that consumption is picking up. There is some pockets of pressure or weakness in lower income brackets, but medium and higher income brackets are spending well, and lower income brackets only represent 25% of aggregate consumption. So what matters really for aggregate consumption is medium and higher income brackets. So in terms of the US, we expect probably the worst to be seen in the third quarter. You can see 1% growth quarter over quarter, seasonally adjusted, annualized, and then the economy gradually picking up. The other big out of consensus call that we have is we don't expect the Fed to cut rates. The market expects the Fed to cut in September, and then again, another 25 basis points before the end of the year, and then continue cutting into next year. The way we think about, and I think the main difference between us and the market has been pretty erratic in pricing a lot of cuts that never happened this year, is that markets tend to think of this type of shocks, immigration and tariffs, as bad for activity and sort of neutral for inflation. The slowdown in economic activity will take care of inflation. Inflation cannot go up when activity is slowing down. And obviously, we learn from emerging markets that this can be or not the case. And we think that in many cases, inflation can go up and activity can go down, even if temporary. For instance, one of the Fed members, Waller, is making the case that the Fed needs to cut interest rates because the effect of tariffs is temporary and the labor market is weakening. Nobody disagrees that the effect of tariffs is temporary on inflation. The question is, how long is temporary? The last time the Fed thought that the shock was temporary was after the pandemic, and they were 1 year late in hiking interest rates because they thought that temporary was 6 months and temporary was 2 years. So the length of temporary is what matters. Life is temporary and death is permanent, but we are not thinking that we're going to die tomorrow. So we think most of the time that we're going to live forever. So this is the same thing. Temporary can be 6 months, can be a year and a half. And in terms of the unemployment rate or the labor market, the way we think about it is what matters is not whether payrolls are going down. What matters is whether there is a slack in the labor market. And slack is measured by the vacancy ratio, the ratio of jobs created versus jobs demanded, and which is around 1 now in equilibrium, and then employment rate. And unemployment rate is about 4.2%. It's not far away from equilibrium. So the question is why payrolls are going down so dramatically, or the revisions were so big. Well, because there is a supply shock also, which is immigration. And Powell has said after the FOMC, the last FOMC, as long as I see unemployment rate relatively stable, I don't care about payrolls. And as long as I don't see the peak in inflation, I need to pay attention to inflation. The Fed has two objectives. Stability of the labor market or employment and inflation. The question is, when the labor market is telling you cut rates and inflation is telling you hike rates, what do you do? And that's, I think, the biggest challenge. And I think the way Powell is thinking about it is similar to our thinking. Powell thinks in terms of risk management. He's going to be most likely wrong one way or another. The question is which mistake is more costly. If he cuts interest rates in September and inflation keeps moving higher, that's going to cost a lot in terms of credibility, and inflation expectations will move higher. And then he will have to hike interest rates. If he stays on hold and inflation doesn't deteriorate a lot and employment goes down, he can cut later faster. And if there is a recession, it's definitely not because monetary policy is too tight. Because if monetary policy is too tight, why the stock market is making new highs every day? Why there is a boom in private lending? So clearly liquidity is not too tight. The rest of the recession is probably more a consequence of the uncertainty in the rules of the game. Companies do not invest because they don't understand how the rules of the game are going to look like 6 months, a year from now. And that's not going to change because you cut interest rates 100 basis points. I'm going to skip Europe and China. By the way, you're going to have access to this presentation. There are a lot of things to discuss. But I would like to make a couple of points about geopolitics, because when I talk to hedge funds, they want to know whether interest rates are going to go up or down next week, which is fine. But when I talk to companies and CEOs of companies, they want to know how geopolitics are going to look like 5 years from now, because they need to relocate their supply chains, and they cannot do it overnight. And we are moving towards mean, we're moving away from a model which was called globalization, in which you produce what is more efficient to produce, to a model in which you produce what is safer to produce, because you cannot run the risk of depending on a critical input that may end up on the wrong side of the geopolitical divide. So those are the questions that CEOs of companies are trying to figure out. Obviously, the answer is very difficult and it's far from obvious. But we are seeing already a diversion of trade. You can see how China is trading more with Belt and Road countries and less so with the US, Europe, and Japan. And the other point I want to make on this is we conducted a survey indirectly through our equity fundamental analysis that covers many public companies that trade in the US. And actually, that was a global survey. And we asked many questions, but two of the questions that we asked is, do you expect a lot of reshoring out of the tariffs increase? And the answer was not a lot, because companies are not going to commit capital for the long term because of tariffs are high today. They might be lower tomorrow. So that's not a sufficient reason to relocate supply chains. And if there's going to be some relocation into the US, it's going to be mostly concentrated in activities that can be automated because of the cost of the labor force. However, companies expect a lot of reshoring. But again, reshoring into which countries? Well, tell me which country is going to be politically aligned with the US or with China, because at the end, the Cold War that we are witnessing is it's a race between the US and China to see who becomes self-sufficient in the production of microchip first, because it's the most important input to win a war. And therefore, in the name of national security, you're going to have a lot of relocation of activities that has nothing to do with economic efficiency. The next point I want to make, and I'm going to go really quickly so I have time for questions, is the elephant in the room for the US economy, which is fiscal policy. We expect the fiscal deficit to be around 6.4, 6.5% for the next couple of years. And that poses a risk, obviously, to the bond market, whether the US economy is going to be able to finance that. And fiscal policy is not only a problem in the US, it's a problem in the UK, it's a problem in Japan, it's a problem in Europe, it's a problem in emerging markets, it's a problem in China. So there has been a huge deterioration of fiscal policy. Countries have spent tons of money they don't have, and eventually someone will have to pay, directly or indirectly. So if you need to finance such a big deficit, which is too big for an economy that is not in a recession, either you accept higher real rates, or you accept higher inflation, or you implement some kind of financial repression, which means either forcing banks to buy treasuries or the Fed becoming the buyer of last resort through yield curve control or quantitative easing. But you can see the revenues and the expenses, and you can see that government spending, 70% is mandatory. It's very sticky. The only way to reduce it is with a social security reform that tells people that they need to work until they are 75. So as you can see, politicians will try everything but doing that. And the final point is, which means that forget about interest rate going back to pre-pandemic levels. That's not going to happen. And the final question is about the dollar. There has been a lot of discussion that the dollar as a reserve currency, it's no longer a valid proposition, that the US is going to lose that exorbitant privilege, etc. Honestly, I don't buy it. I don't think it's going to happen for a simple reason. Who's going to take the other side of the coin? If the dollar depreciates 20%, that means that other currencies have to appreciate roughly that amount. Do you expect the Europe to be able to tolerate a euro 20% stronger? With this level of the euro, Europe is going to grow less than 1% for the next 2 years. No country can absorb such a real appreciation of their currencies without consequences. So eventually, maybe you don't like the US story as much as 9 months ago, but to be honest, it's much better than any other story. And this is what we are seeing in global portfolios, that after the initial reaction to Trump policies, the dollar deteriorated. I mean, the dollar weakened because global portfolios were massively long US assets and short European assets and emerging market assets. And now, once they rebalance, they go back to the US. And that's why the stock market is making new highs every day. So I will stop there and open to Q&A if there is any time. Maybe there is not. OK, good. Thank you very much. OK, change of plans. OK, whatever. Questions? Yeah.
Yes. Not the world, but along each fellow global economist. And my biggest fear and a question for you. Can you hear me?
Yes, perfect.
How concerned are you with respect to what has happened with the BLS commissioner and government economic data? And just today, saw an article in the Wall Street Journal, the economist with Goldman, basically Trump administration saying he should be let go for telling, obviously the situation with respect to what they're expecting, as most economists are expecting higher inflation, lower growth, stagflation. How concerned are you about what is happening?
About losing my job?
Yes. Also,
look, the BLS produces a lot of data. Some of that data you have in the private sector alternatives that you can look at for inflation, for the labor markets, but not at the depth that you have produced by the BLS. I think it goes without saying the importance of having reliable statistics. And I think that the common sense will prevail. And honestly, I think we need to slow down and see how the new head of the BLS approaches the issues that you might have. There is an issue, for instance, the reason why you have such a big revisions in payrolls is because by the time you release the first estimate of payroll, only 60% of the people responded to the surveys. And then over time, people respond more and more, and then you have more reliable statistics. So there is a trade-off between having the perfect answer to the payroll number 3 months later or an estimate much sooner that allows you to take decisions more timely. Can we improve the processes? For sure. Maybe there is something to do there. So I think I open to the idea that processes can be improved, but it's very, very important that people rely on the statistics, and that should not be negotiable. Yep.
Yeah. Hello. Yeah. You talked about the dollar, how the value of the dollar changes if it decreases, someone has to gain it. So how do you see BRICS, which constitutes around 40% of the global economy? They are putting in efforts to make their own currency and to de-dollarize the economy. So how do you think that will impact the value of the dollar? And if in case it impacts in a negative way, what changes do you see in the market?
I think two things. I don't think the dollar will depreciate dramatically versus other fiat currencies, but I think that most likely gold will appreciate a lot against all the fiat currencies because all the countries have fiscal problems, and in that scenario, gold becomes king. Relative to BRIC currencies, obviously those currencies don't have the depth of of the dollar or the euro or the yen, but you're going to see more regional trades settled in renminbi, and therefore the renminbi can become more interesting as a regional currency. However, the renminbi, it's still less than 3% of global payments. And it's not reliable from the perspective of central banks as an alternative to the dollar or gold. Gold became actually the second most important currency, if you want to call it that way, currency holdings of central banks, even bigger than the euro. So there is a long way to go. You have to remove a lot of capital controls in China in order for the renminbi to become a valid competitor to the dollar. It's far away from that. That doesn't mean that you're not going to have more trade settle regionally in renminbi. That should probably happen. It's already happening. Okay, thank you very much. Sorry for going long. Thank you. Okay, absolutely.